Credit card companies don't make money when you pay off your balance, they make money when you don't. And everything about how credit cards work, the interest rates, the minimum payments, the rewards programs, is engineered to keep you in debt for as long as possible. This isn't a conspiracy, it's their business model. So in this video, I'm going to show you exactly how credit cards are designed to trap you and how to avoid it. Here's the first thing you have to understand. Credit card companies make money in 4 ways. Fees from merchants whenever you use your credit card, fees from late payments and balance transfers, other stuff like selling your data, but the big one, the one where they make close to 50% of their entire revenue from, is interest. That's the money you pay when you carry a balance month to month instead of paying off your card in full. And to show you guys how much banks really make off this, let's look at it from their perspective. Imagine customer A pays their card off in full every month and spends about $2,000 a month. The bank earns roughly 2% in merchant fees, and that's about $40 a month before costs. Now imagine customer B. They carry a balance of $5,000 at around 22% interest. That alone generates about $1,100 a year in interest payments, plus the same merchant fees on top. So one customer generates the bank a few $100s in fees, while the other customer generates over $1,000 a year just in interest alone. And that's why customers who carry balances are far more valuable to credit card companies than people who pay off in full. And this isn't speculation. This is from bank earnings reports. Companies like Capital One, Discover, Chase, they break down their revenue, and income from interest payments is consistently 45 to 50% of what they make. The entire business model is built on you not paying off your card. Everything else, the rewards, the convenience, the marketing, is designed to get you to use the card more, spend more money, and eventually carry a balance so they can charge you 22% interest on it. Now let me show you how minimum payments can actually destroy most people. Most credit cards set your minimum payment at around 2 or 3% of your balance, or at $25, whichever is higher. So let's say you have a $5,000 balance at around 22% interest, and you're only making the minimum payment every month. That first payment might be around $100, but almost all of it goes straight to interest. Only a tiny piece actually lowers what you owe. After a full year of making these payments, you sent the bank over $1,000, but your balance has barely moved. After a few years, you've paid thousands, but most of it was just interest. If you keep paying only the minimum payment, it can take close to 2 decades to get out of that $5,000 balance. And you can easily end up paying more than double in interest than what you originally spent. And the crazy part about all of this information is that the credit card company is required to show you this on your statement. There's literally a box that tells you if you make the minimum payment, this will take X years and cost you thousands more. But most people ignore it because a few $100s a month seems manageable. It feels like progress, but it's not. You're just running on a treadmill, thinking you're going somewhere while the bank just keeps collecting interest. And it actually used to be way worse. Years ago, the minimum payment could be so low that you could make payments forever and barely touch the balance. Regulators eventually forced banks to raise minimums slightly, but even today, the system still keeps people in debt for a very long time. They didn't fix the problem, they just made it slightly less worse. So let's talk about why credit card interest rates are so insanely high. The average credit card APR right now is around 21%. If you've got great credit, maybe you're paying 15 to 18%, and if your credit is average, it's more like 22 to 25%. And store cards and lower credit scores can easily hit 25 to 30%. Meanwhile, mortgage rates are around 7% and auto loans are 6 to 8%. So why is credit card debt 3 to 4 times more expensive? It comes down to how the law changed. Before the late 1970s, most states capped interest rate. Then, a Supreme Court case allowed banks to charge the interest rate of whatever state they were based in, even if the customer lives somewhere else. So many credit card companies moved their headquarters to states with no rate caps, like South Dakota or Delaware, and suddenly they could charge much higher rates legally. On top of that, most credit cards have variable rates tied to the Federal Reserve, When the Fed raises rates to fight inflation, your credit card rate automatically goes up. You don't get a choice. In 2020, rates were near zero and cards were charging closer to the high teens. By 2024, rates jumped and many cards started charging over 25%. Your debt literally became more expensive overnight, and most people never even noticed because it's buried in the fine print. Now, there are a few subtle ways credit cards quietly encourage you to spend more. First is with credit limit increases. You've probably seen this. You've had a card for a few months, you're making payments, and suddenly you get an email. Congratulations, we've increased your credit limit from $5,000 to $10,000. It feels good. It feels like you're being rewarded. But in reality, what they've done is given you access to more debt. And a lot of behavioral research consistently shows that when people are given higher credit limits, spending tends to increase. The more available credit you see, the more comfortable you feel spending it, and that increases the chances of carrying a balance. Second is rewards programs. 2% cashback sounds amazing, but studies show people generally spend more when paying with credit compared to cash, because the pain of paying feels delayed. Because if you're paying something with cash and you literally see the cash leave your hands, it's very obvious to you that this thing costs a lot of money. But when you're just tapping a card, even though it's the same principle, you're still losing money, it doesn't feel the same. It feels like you didn't really have to pay for that. But the worst part is, if you're carrying a balance on your credit card, none of the rewards matter. Earning 2% while you're still paying 20% interest means you're still losing money unless you pay off the card in full every month. And third is something called 0% APR. On paper, it looks like free money. Purchase something now and pay no interest for 12 to 18 months. But a lot of people still have a balance when that promo ends, and when it does, the rate jumps back to 20% or higher. Suddenly, what felt like free money becomes very expensive debt. And fourth is the sneaky way the apps show available credit. Your app might say available credit $8,000, and your brain treats that like it's money you have, but it's not. It's borrowed money you haven't taken yet. And when something feels available, we're more likely to use it, even when it's actually a liability. And the worst part about all of this is that the average American actually has 3 to 4 credit cards, and 45% of cardholders carry a balance month to month. The average household credit card debt among those with debt is almost $8,000, but the median is only $2,700, which means a lot of people have way more than $8,000 and they're actually pulling that average up. Alright, so how do you actually get out of this without swearing off credit cards forever? Step 1, stop adding new debt. You don't need to destroy your cards, just pause using them for everyday spending while you're paying balances down. Remove them from your online shopping apps, food delivery apps, anywhere that makes impulse spending easy. You can't pay down a debt if the balance keeps growing. Step 2, list every card you have. The balance, the interest rate, the minimum payment. Once you can see the full picture, you can actually build a plan instead of guessing. Step 3, pick one of these 2 strategies to paying off your debt. Number 1 is something called the debt avalanche, which basically means you pay the minimums on everything and you aggressively attack the card with the highest interest rate first. That saves the most money mathematically. Or number 2 is something called the debt snowball, which means you pay off the smallest balance first to build momentum and motivation. Both work, but pick the one you'll actually stick to. Consistency matters more than perfection. And step 4 is to widen the gap between what you earn and what you spend. That means increasing income anywhere possible, overtime at work, selling unused stuff, and tightening expenses temporarily. Every extra dollar you put toward debt is a guaranteed return because you're avoiding 20% interest. And the final step, call your card issuer and ask for a lower rate. It sounds awkward, but it works more often than people realize. Just say, I've been a customer for a long time and I'm looking to lower my interest rate. If they say no, you're no worse off, but if they say yes, you could save hundreds of dollars in interest over time. Now, if you're in really deep, meaning you're struggling to make minimum payments and the interest is completely overwhelming, there are more structured options to consider. One option is something called a debt consolidation loan. That basically means you're replacing high interest credit card debt with a single personal loan at a lower fixed rate and clear payoff timeline. This can work if the new rate is meaningfully lower and if you're disciplined about not running the cards back up. Otherwise, it'll just create more problems. Another option is nonprofit credit counseling. Organizations like the National Foundation for Credit Counseling can help negotiate lower interest rates with creditors and set up a structured repayment plan with one monthly payment. This can simplify things and usually has less long-term credit impact than bankruptcy. And finally, as a last resort is bankruptcy. It can wipe out credit card debt, but it also has long-term credit consequences and legal costs. It's something to consider only if someone genuinely cannot meet monthly payments despite trying every single other option we listed. The main takeaway from the video is this: credit cards aren't designed to help you build wealth, they're designed to generate profit for the issuer. And the way they make the most money is when people carry balances for long periods of time. Minimum payments are structured to feel manageable even though they keep you in debt for years. And interest rates are often 3 to 4 times higher than most other types of debt. And things like credit limit increases, rewards programs, and 0% APR promos are all designed to encourage spending and take on debt. Now, I'm not anti-credit cards at all. I actually use several of them myself. Credit cards can be great tools for convenience, fraud protection, and rewards if you use them correctly. The way I live my life is if you use a credit card, pay it off in full every single month. Never carry a balance, because the moment you start paying 20% interest, the rewards don't matter anymore. You're giving the bank way more than you're getting back. And if you already have credit card debt, make eliminating it your top financial priority. Even before investing, paying off a card charging 22% interest is essentially a guaranteed return that almost no investment can consistently beat. Use credit cards as tools, not as loans, because when you control them, they can actually work heavily in your favor.